The active versus passive debate is a heated one in the asset management industry, with strong views on either side. PSG Asset Management is unashamedly a bottom-up active manager, and joining me today to unpack our views on the subject is fund manager Dirk Jooste. So it's often stated that very few active managers succeed in outperforming the market over the longer term. But how does PSG Asset Management, as an active manager, think about this subject?
Thanks, Audrey. Yes, this is definitely a very interesting a topic to consider. Always in markets, it's quite dangerous to make too strong generalizations. There are always cycles when we look in any area of the market. What we've recently observed, it has been a very good cycle for passive investments. And it's been actually quite dominated by large and mega cap companies of note. Passive doesn't come without risks. So investors typically, it's quite important just to take stock after a good cycle and consider the risks to investing in that way. There are a couple of cyclical elements that's worth highlighting. That's probably masking the benefits that an active manager could bring to a broader market portfolio. A couple of things to note, and I'll just use the S&P 500 as a case study. And it's also important as the S&P actually does dominate world market portfolios at the moment. If we look at longer term history, let's say over the last 90 years, there's actually been a few decades which has been very difficult for the market portfolio. Maybe 3 out of the last 9 decades you could frame as lost decades. These were decades where very little real returns were generated for investors. And that's also particularly important just to highlight, given that we've actually gone through a very good decade for the markets portfolio. The second element is what we are observing today. The markets are very concentrated. So it's very dominated by very large and mega cap companies. Now, Bridgewater, this is Ray Dalio's company, they actually did a very interesting study recently, looking back over the last 125 years, where a similar dynamic was in play in the markets. And what they found is typically very difficult for these dominating companies to hold on to their position of influence in the market indices. So this is typically a very strong headwind to performance looking out to the next decade. And then thirdly, the last decade was particularly tough for active managers, partially due to the fact of the mega cap dominance, but also valuations has been becoming a bit of a concern looking at the market. So there are questions if the market can actually hold on to the gains it has realized over the most recent time. And if you do look at longer term time frames, you observe quite a bit of cyclicality from passive and active. There are cycles where active outperforms, and then we've just gone through a cycle where passive outperform. So these are a couple of cyclical elements that investors just need to carefully consider when maybe concluding overly black and white around this debate, and especially going forward.
So if simply replicating the market return is not necessarily an answer, what are some of the perhaps overlooked benefits that active managers bring to the table?
So let's take equity as an asset class. When investors invest in equity, they are investing with a longer term mindset. Equity offers a high level of real returns, but the trade-off is it does come with volatility. Now, academia would refer to this as the equity risk premium, and that's typically 5 to 7% above inflation. So investors are accessing the equity asset class to generate these inflation-beating returns. Now, when it comes to portfolio construction, this is almost portfolio construction one-on-one. If you can have two processes that deliver over the long run on the required outcomes that investors require, but the two processes do this in a very uncorrelated way, there are significant portfolio construction and client journey benefits. This is particularly important. I think a lot of investors tend to be very short-term focused when they look at active versus passive and contrasting quarterly or even annual performance numbers to see which are over and above. But this might be missing the bigger picture if you can identify an active process that's very differentiated. Over the short run, it might differ materially from the market's performance. But if you can have a process that over the long run delivers on that inflation-beating returns and put that alongside the market portfolio, it can have tremendous benefits.
Some investors would be skeptical of the ability of a manager located in South Africa to manage portfolios on a globally integrated basis. So how does the passive versus active debate play out for PSG Asset Management when considering portfolios on a global basis?
So we've been investing globally since 2008, and the process we apply locally is exactly the same process that we apply globally. The concept of finding mispriced securities is quite a dynamic one, and we migrate into areas where we find the odds of mispricing to be elevated. At the moment, what we are observing globally, most notably in the world market portfolios, they're deeply in favor. So valuations for us is a bit of a concern, and the market concentration is a concern. But while this dynamic is ongoing, you would find the areas that's away from the market, there are actually quite a few areas that's out of favor and neglected. And in these areas, typically you would find that the opportunity to go look for mispriced securities, it's quite a rich environment for that. Similarly, locally, we've been in an environment where South Africa has been deeply out of favor for a long period of time. And typically how the market works, and perhaps in an inefficient way, when there's uncertainty, the market will embed a risk premium into assets pricing. And most of times it's very behavioral. This premium tends to be excessive when there's lots of fear and uncertainty. So it's a very rich environment for us as well to go look for those mispriced qualities or inherent qualities within assets that the market is missing. So it's a very dynamic concept. Even though global markets are very expensive at the moment, we actually do find a very rich global opportunity set just because there's so many areas of the global markets that's being neglected or ignored at the moment. So our process is integrated, one process we follow local and globally, and we've been doing this since 2008. And we do find equal amount of mispriced securities local versus global. And again, this is a dynamic concept. We might find ourselves in 5 years' time where South Africa is deeply in favor, and we will in turn migrate to other areas then to go look for these opportunities for our clients.
Dirk, to wind up this conversation, I think fees are one of the key elements of the active versus passive debate. And as we all know, passive managers tend to charge lower fees and active managers tend to charge higher fees. So is active management worth a fee?
Yes, Audrey, this is a very important consideration when looking at active versus passive. What we observe in the market, many participants that do use the active label, they still tend to be very close to the market portfolio. Typically, they would over or underweight sectors or securities according to their views. But in reality, the end result still remains very similar to what the market is delivering. Now, what we believe at PSG Asset Management is to provide clients with a highly differentiated active element or product that they can put alongside the market portfolio within their funds. And if we are able to generate the required returns from that our clients need, but do this in a very differentiated way, we most certainly would feel this is definitely worth a fee, as it can have a very meaningful bearing in longer-term client outcomes and journeys.
Dirk, thank you so much for joining me today and unpacking this contentious topic.
Thank you, Audrey. Appreciate it.